Hey, everybody. Welcome to the Get Wealth Podcast. I'm your host, Brennan Wiersma. Please be sure to like and subscribe if you haven't already. You want to stay up to date on our latest videos. We got some really cool ones coming out. I'm excited to share what we got going on here. Today, I'm talking with John Krafchick, financial advisor, entrepreneur, business owner, all around money guru. I'm excited to hear some of the stuff you have to say today, man. So thanks for being on the show.
Yeah, for sure. Let's get rolling.
Yeah. So I guess starting off, when did you start learning about finance? And, how has that grown into what you do today?
Yeah, so my introduction to the stock market was in the third grade. I got 2 shares of Disney. So I would literally like come home from school, like ride my bike. It was super downhill. I used to have like one of those like Mongoose BMX bikes. Like I think that's what everyone was like rocking in elementary school. Like if you didn't have a Mongoose, you weren't doing it right. And I'd like come home and hop on Yahoo Finance and check the market. I'd be like, hey, I made $1 today. Hey, I lost a quarter. And I believe Disney was trading at like $24, $25 a share at that point, and it's hit like 180 recently. So since then, I've been watching the stock market pretty much not every day. As a kid, you get bored with things. So I mean, I was watching it for a while, but our attention span as children is so small. So I eventually just stopped watching it. But then again, when I went back to Florida State, I got my degree in actuarial science, and I started really learning about how all math leads to finances and how it actually works. It's not just like numbers on a screen, but how do those numbers on a screen actually become those values? So that's how I got introduced into the stock market.
Wow. So pretty young. And, one of the common themes with investing is, the more time you have, the better. It's, you can leverage the compounding interest and things like that as far as,
Right.
especially with the stock market. So where did you say you went to school at?
I went to Florida State University in Tallahassee, Florida. Ended up originally was doing accounting, got bored with accounting. I thought it was too easy. So I actually went to the math department and met someone by the name of Esther Diagula. She was a little old lady, probably in her mid 60s, and I was 18, 19 years old at the time. And I was like, hey, like I've always been good at math. Can I add a math minor? I want to learn. I'm here at school. And she's like, have you ever heard of actuarial science before? And I was like, exercise science? And she's like, no, actuarial science. I was like, oh, I've never heard of that. She goes, I think you'd be a good fit for it. And I was like, okay, Esther, I trust you. I'm like 18, 19. I'm going to listen to what an adult has to say because we think adults know what's going on in the world. And then we figure out that no one really knows what's going on in the world. And that was my introduction to actuarial science. Ended up failing the class the first time around. Did not know like math could actually be hard, but thinking it's a different kind of math. It's just it really challenges the way you think and the way you view the world, which is why I failed it the first time around, but stuck with it and ended up finishing out strong.
Wait, so actuarial science, I have absolutely no idea what that is. How is that different?
So
Yeah.
so actuarial science is the study of risk using statistics. So the job that you're supposed to get is you work for an insurance company and you dictate how much people pay for their health policies and things like that. Um, but when I graduated in 2012, the job market was really thin, so I ended up getting a job at Fidelity Investments,
Hmm.
which is one of the largest financial firms in the world, and that was my introduction to quote unquote financial advising at that point in time. So I never thought I would be in the money business. It just so happened that I ended up buying stock at a young age, studied the mathematics and the statistics behind stocks and investments, and then ended up by accident getting into the financial industry. So it's nothing I ever pursued. I didn't watch like Wolf of Wall Street with Leonardo DiCaprio and go on a 5-day bender and think, oh, I'm gonna be a stockbroker.
Yeah, for sure. Yeah, it's finance has really interested me because it's one of those things that, to some level, I think it's important for everyone to, you know, have an invested interest in, because, I mean, that people want to do what's fun and what's enjoyable right now. And even if they're not super interested in finance, it can be very beneficial for their future to be able to have fun and do those things they want to do. And I think especially at a young age, it's easy to not pay attention to things like retirement because it doesn't sound very fun. But I mean, what's cool
No, it's not a sexy subject.
but I mean, the more I try to study it and learn it and talk to people like you, I just become more interested. And I'm like I've almost found this weird passion where I'm like trying to learn as much as possible. And yeah, I think there's a lot of stuff to learn. So the sooner the better. And yeah, that's awesome. That's kind of how you did it. I mean, even that
Yeah, I mean, it's all
investment.
happened on accident. It's crazy. I mean, you hear Gary Vaynerchuk say like being an entrepreneur wasn't cool. Now it's cool. Investing in the stock market when you're in high school isn't cool. That's not going to get you any popularity points. But now, like all of these, there's been like these seismic shifts in all of it, what's cool versus not cool. Because like everyone wants to talk about like what stocks they're trading, what investments. Obviously, everyone's talking about AMC and GameStop now because it's their first experience with a short squeeze situation. But these things happen a lot.
Mm-hmm.
It's just people don't pay attention.
Yeah.
But now that so many people are invested, they have to pay attention to these things, and then it becomes a topic of a conversation with your friends, family, etc.
Yeah, I mean, the 2021 being the time your first experience with the market, that's insane because I mean, would you say that the last week has been probably the one of the crazier times in the market in like the recent history, even maybe 2008? What would you say the scale of
Yeah,
it
I
has
mean,
been?
it's been the craziest time in terms of like headline news. I mean, Robinhood was just fined $65 million before this even happened.
Okay.
We've seen in uh, documentaries on Netflix, such as what is it, The Social Dilemma. They're
Hmm.
like, if there is no product, you are the product. So everyone's signing up for Robinhood, thinking you're getting free trades. Robinhood skimming the top. So if you buy a stock for $1, they bought it for 90 cents. They're pocketing the dime. And these are the platforms people are being introduced to, and then having these either a positive experience where they've been making a lot of money because the market's just been going up, 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 or having a negative experience where their account gets frozen and they end up losing everything that they invested or the lion's share of their principal. And then they're like, crap, like this isn't what all my friends told me it is. So it's always like one way or the other. Like people either have a really positive experience at the beginning of investing or they have a really bad experience. And the thing is, most people don't have as much money as these hedge funds. So when a situation like AMC and GameStop happens, you don't have enough money in your bank account where you can basically manipulate a trade to make the odds swing back into your favor. And that's
Yeah.
exactly what ended up happening. And that's the with most investors, we don't know how to fix mistakes. It's just like either you win or you lose.
Yeah. Yeah. No, I do want to get into both of those things, but first, because I actually saw your Instagram post. You have a lot of good little IGTV videos that
Oh,
um,
thank you.
you
I
post.
just started doing them like a year ago.
Yeah. So the one you mentioned about Robinhood, it's like, what the heck? $65 million. So I did some research on it, and that's pretty crazy. And that's before they were even in the really the mainstream news with what's going on now. So can you talk about a little bit of what they got in trouble for?
Yeah, so a few years ago, a lot of the big companies started giving their customers free trades because millennials were entering the marketplace. And I'm a millennial myself, so I can jab a little bit at the generation I'm a part of. I think that's still politically correct. You can make fun of yourself still.
Yeah, that's fair.
Millennials are cheap. They don't like paying for things. They always want like the best deal when it comes to free trading online, to getting 50% off apparel. But when it comes to like buying the new iPhone, they'll drop $1,000 really easily. It's like very weird.
Yeah.
So these big financial institutions realize, hey, if we offer the millennials free trading, they'll come on and use our platform. But the stock that you're buying or the investments that you're buying from these platforms isn't directly from the farm. So like if you go to Costco and you buy a Costco membership, that costs money, but then you get all of your food at a wholesale price. Versus if I go to a mainstream grocery store, maybe like Walmart, I'm probably going to pay maybe a little bit more than Costco, but it's free for me to walk into a Walmart. So when you're using these major platforms such as Webull, M1 Finance, TD, Thinkorswim, if you buy a stock for, let's say, $10, you could be buying stock they bought 10 years ago for $1. So the company is basically just a quote unquote market maker. So what a market maker is means that you're not going to the stock exchange floor to buy your stock. You're basically buying it from these institutions and they're selling it to you at zero commission, but they're basically making profits on the stock that they have in their inventory. It's kind of like the friend in school that would like always say they're giving you a deal when you need to borrow money or do something, but then they end up knowing that they're on the winning side of the deal, even though on the front end, they're like, yeah, here you go, just take this.
Yeah, no, 100%. And Robinhood, like you said, kind of that target market being millennials or new investors, they make it seem like a game where you have these like a few buttons, buy, trade, so like you trade, buy, sell, and then when you process anything, there's confetti. It's really simple. You can see everything just like right in the little columns they have for it. And so it almost is taking advantage of that, that simplistic mindset of like, it's just a game. And, people are making, especially even with what's going on with GameStop, there's not really any sort of fundamentals of investing that's going on there. It's just market hype. And then,
right.
Jumping on the wave. I actually read an article from NPR that was talking about that lawsuit, the $65 million. And they had an anecdote in there about a guy who had like $700,000 invested, and it was a glitch on the app, and he couldn't get his money, and then ended up killing himself, which that's pretty terrible. But it kind of just shows.
Yeah, it was someone that did an options trade. He was, I think, in high school, and there was a glitch, and his yeah, he was a young kid, maybe high school, maybe like just in college. I can't remember exactly. But basically, he was doing an options strategy, and he didn't know that the funds didn't settle. So it showed in his account that he had a $700,000 loss just because he did such a strategy where he like longed a call and then shorted something and then did something else. I don't know exactly what he did. But basically, when it showed on his app, it showed them at a $700,000 loss because his funds hadn't settled and he didn't know what was happening, and he ended up throwing himself in front of a train.
That's terrible, man.
Yeah, crazy.
Yeah, that's one of those things with investing. It's probably better the less emotionally attached you are to your money, right? Is that what you'd say?
Yeah, but I mean, easier said than done. Right. I mean, people value money like religion. I mean, it's like religion, family, money. Right. Maybe not in that order, but I mean, those are the big three. And if you can become like a robot with your money when you invest money and it loses 50% and you just don't care, that you're on to something. Versus in the beginning, it's very exciting. Your adrenaline's pumping. You're not investing a whole lot of money when you start. You're like, all right, $500. All of a sudden your 500 turned to 750. Then your 750 turns to 600. Then your 600 turns to 3,000. And you're just like, oh, this is crazy. However, as you move in your career, you're not going to be playing with $500. You're going to be playing with $500,000. And do you really want to see, are you really able to stomach $500,000 turning into $250,000? Because that's a 50% loss versus 1,000, you go to 500. It's a 50% loss too, but losing 250 grand is a lot more painful than losing $500.
Yeah, definitely easier said than done, like you said. And in your Instagram bio, it says you're teaching millennials how to, become millionaires or enter the top 1%?
Yeah, we have yeah. Who wants to be other than the top 1%? Who wants to be average?
Right. Is that part of your teaching? Do you kind of guide people to be more robotic with their investments, or what does that look like for directing it to millennials?
So right now, I mean, a lot of people, they're like, what's the best investment right now? Like, you got friends talking about crypto, you got friends talking about ETFs, stocks, real estate. It's like, which investment is the best? That's like the question. Like, which one's going to make me the most money as fast as humanly possible with the least amount of work? However, I mean, that's the honest truth. Like, no one likes to work.
Yeah.
I actually stumbled upon a quote by Thomas Edison a few few months ago, and it says opportunities missed by most because it's dressed in overalls and looks like work. And when it comes to the stock market, I mean, anyone can invest $1,000, and you could have got a free AMC stock from Robinhood and not even known it. And then all of a sudden, that stock, you just made some easy cash. You're like, oh, this is easy. But when it comes to becoming the top 1%, if that's your goal, to be a millionaire or a billionaire, obviously that's a very big stretch goal. You got to start thinking like the 1%. And I mean, do you think 1% people invest in ETFs? No.
Why not, right?
Definitely not. Also, there's been a big misquote. Everyone says Warren Buffett just says buy the S&P 500. There's a famous thing that says that he like challenged hedge funds that they can't beat the S&P 500 over a 10-year period. So I mean, there's a lot. People are like, yeah, Warren Buffett says invest in the S&P 500. Well, which companies does he own in the S&P 500? A lot of them. Yeah. So the chances of you owning a part of his companies, if you buy an ETF, is much higher probability than you going out and choosing one of the companies that he owns as an individual stock. So that quote, even though it's a misquote, because he actually says in the video, which I can share with you, Brendan, if you want to share it with your audience, he says, sure, if you are looking to bring an intensity into the game, then Warren Buffett has been, filmed saying he believes that diversification is a terrible mistake if you're looking to bring that intensity to the game. Wow. But if you're looking to be ignorant, then just buy the ETFs. Like, don't worry about it. It's going to go up. It's going to go down. Overall, you'll be good. But with the index funds, you're only guaranteed to do as good as the index funds. So you're limiting your potential rather than if you want to think differently to be in the 1%, then you got to start doing what the 1% investors do. So that's the idea is, I mean, it's not for everyone. A lot of people say they want to be in the top 1%, but when it comes down to it, it does take a little bit more effort. Mm-hmm. So that's my mission, is to educate people on the best ways to grow their wealth. So, I mean, if you're good at fixing things, perhaps that's real estate, because you don't have to hire people to fix things around the house, which eats into your return. Like, I'm terrible at fixing shit. Mm-hmm. So like owning real estate is probably not the best for me. But when you look at the research, real estate has created the most millionaires in America. Right. It's like 80 to 90%. But it also has, but it's also forced the most bankruptcies. That makes sense. So that's, so I mean, real estate's great. The stock market's great. I mean, you got to push buttons. I mean, how hard is it to push a button? Not hard at all. And then also now you have things like the cryptocurrency market that doesn't even sleep. It's just constantly going 25 hours a day, 8 days a week. So it's like, how do you monitor that? Yeah. I mean, there's so many avenues that you can take to invest. And like you were saying, it really does take almost that Warren Buffett perspective of just like finding the value in your investments and profiting off that. And I mean, the S&P 500 or index funds, it's better than just keeping it in a checking account, right? Because, of course, you're not losing money. But if you really are focused on building real wealth, like that Warren Buffett type of scaling of your wealth, it's going to take some of that hard work and, hard hat and lunchbox, and putting in the work. You can't just look at a chart and be like, oh, I like this chart, let me buy this. Like, you got to do a little bit more digging than that. Obviously, that's how a lot of people trade. They're like, oh, look at the chart. Yeah. No, it's kind of interesting. I was going to ask you about a few stocks too that I've been curious. I've been doing some research on, and I wanted to hear your take. Have you heard anything about Rolls-Royce recently, or as far as what they're? I've seen their stock price is really low. Yeah, it's like $1.30 or something. It was a couple of days ago. On paper, they seem like they're not great. Their liabilities are more than their assets. They're in quite a bit of debt. They aren't making a whole lot of money, but neither does Tesla. Yeah. Oh yeah. So that's you can't always go off that, right? But like a true fundamentalist would be like examining all the numbers. But to me, it seems like Rolls-Royce has a very low chance of going bankrupt because of how much they're involved with other countries and all these different industries, and the barrier to entry to do what they're doing is very high. So they're not going to have a lot of competition. It's a
And
very niche market.
yeah, so like they're at $1 right now, but do you think that's a good buy to, um, get at least a little bit, or at least for speculation that they might go back up after the airlines come back and everything?
I mean, at $1, I mean, how long Rolls Royce has a very strong brand. I don't know the fundamentals of their balance sheet, but it sounds like their liabilities are greater than their assets right now. I mean, that could be because they bought some new machinery. Maybe they expanded. A lot of people don't realize the reason Amazon builds these warehouses across the country is real estate is a huge tax deduction for these companies. So basically, if you have a big warehouse and Amazon's built a bunch of them, that gives them a huge tax write-off on their corporate earnings. So that allows them to increase their earnings per share, which then helps their stock price. So perhaps Rolls-Royce invested in some new machinery.
Hmm.
I mean, Rolls-Royce, the brand itself is very valuable, which is something that you can't really put on a balance sheet.
Yeah.
So I mean, as far as throwing a couple bucks at it, I mean,
Yeah, just because
got,
I
got,
mean it's
got nothing to lose. I mean, maybe like a company like Tesla would pick up Rolls-Royce, or maybe Rolls-Royce will team up with a Volkswagen, which is a very diversified brand. I mean, Volkswagen, I think, owns Porsche, which people don't really know about.
Hmm.
So that's under the Volkswagen brand. And with everything going electric by 2030, who knows what's going to happen with the automakers.
Yeah, and another part of Rolls-Royce that I think is overlooked is their role in the future of space travel. Because I think they've already created a rocket that can reduce the time to space by like 2/3, and
Really?
yeah, it's like
That's
a crazy
Didn't know
new,
that.
and they have a contract with Virgin Galactic recently, and I can see them
I
like
love
partner.
Richard Branson.
Yeah, I know. It's just those are the guys that never fail. Elon Musk, those guys. If they were to partner up, and I don't see why that stock couldn't just triple if they start getting involved with space travel. But anyways, it's so do you think that speculation is all is I guess a negative thing sometimes? If you were to base how much of your portfolio would you base off of like speculation?
As of right now, zero. But there have been times where you got to make speculative plays that when you got to be a little contrarian sometimes. You got to go against the grain, such as when the California wildfires were coming out. A lot of people don't even realize that the utility company, I think it's PG&E is the name of it, they're publicly traded and their stock price plummeted because of all the fires and the lawsuits and this and that. They're trading, I want to say, in the 60s. They went below 10. Um, then lawmakers found that the fires weren't at fault. Then within a matter of seconds, they went from below 10 to above 25 really quickly. Now they've gone back down over time because there's still a lot of uncertainty with the market. But I mean, there's times where these companies that are major brands have their backs against the wall. But you believe in the company, you believe in the model. So you go against the grain a little bit and throw a dart at the wall and see what happens. Obviously, speculation is not the way you want to build wealth, but you do have to take some gambles in order to propel yourself into that 1%. So that's what
Yeah.
I mean. Those are my thoughts. Like, you got to take a little risks
Mm-hmm.
at times. Like, probably the best move I ever made was Bank of America was at 12. And I was like, I don't think it can go much lower. So I went all in on Bank of America, like my whole portfolio. Then it went to 25. And so I made 100% on 100% of my money within a year, something crazy. And then I pulled out completely and diversified and spread my risk out. And that was the play. But I mean, there's some times where you just got to go all in. You're like, hey, like, I'm just feeling it.
Yeah, that's so cool, man. So as far as like risk and kind of going against the grain, doing your own thing, you've created 3 of your own companies, and it looks like you even have a patent. Can you talk a little bit about that and what those are?
Yeah, so the financial firm is 369 Financial. It's a registered investment advisory. We're based in Ponte Vedra Beach, Florida. So we do primarily 2 things there. We do financial coaching, where we coach individuals on their money, whether it's choosing investments, paying off debt, saving money. That's the big 3 that most people have trouble with. The other companies are the Millennial Guide blog, just helping educate millennials on adult subjects so that they don't get taken advantage of: business, money, health, relationships, just pretty much everything they don't teach us in school. I've been doing that for a few years now just to get my message out there, show as much value as I possibly can for free. I mean, that's the market that we're in. We have to show value for free before we get rewarded.
Yeah.
So that's just like my way of giving back. And then lastly, the third company that we currently have is called Don't Have a Stroke. It's a golf invention that helps golfers with their mental game so that they can reach their full potential. And we have a big meeting coming up with a company that we are partnering with called Launch Boom, which is the top, if not one of the top crowdfunding companies in the world. So that's something that we're hoping to come to market. And it's crazy because COVID came out and golf is up 200 or 300%. So now we have a bigger market for all these new golfers out there. So it's kind of like COVID stunk and delayed us a little bit as far as manufacturing the product, but at the same time, it allowed us to tap into a new market of golfers because you can't really catch COVID in a field.
Yeah.
When you're 100 feet away from everyone.
Yeah. So how does that work? What's the invention? How do you help them with their mental game?
So I started playing golf about 4 years ago, and we were playing golf on the day of my best friend's wedding. And after hole 12, he told me I couldn't play anymore because my golf swing resembled the bastard child of Charles Barkley's golf swing. Which, if you don't play golf, that's not good. I know they just had the event with Phil Mickelson, Charles Barkley, and Peyton Manning and Steph Curry. Yeah. So Charles Barkley is like the worst golf swing in the world. So I started taking it upon myself to get better at golf. But golf isn't a game where you just progressively get better. You almost have to accept getting worse in order to get to the next level. So one day my friend was actually keeping score for me. And I had like the most fun I've ever had. Like, I was hitting the ball good. I was like, I don't know what my score is, but I feel like I'm doing all right. And then when I tallied everything up at the end, it was one of my best rounds ever. So I thought to myself, how can I replicate this every time I play so that I can free up my mind? Because golf, like stock investing, is a very mental sport. And you got to be on it every day. Otherwise, you're going to make emotional decisions which work against you. Such as in golf, it's like, should I go for the green in 2 or should I just lay up? Kind of like doing a speculative stock play. Should I go all in here or should I just invest as much as I'm willing to lose? Obviously, if it pays off for you and you make the green in 2, you're putting for eagle on a par 5, or if you go all in on AMC or GameStop and it works out for you, you could become super wealthy in a short period of time. But at the same time, you got to check your emotions at the door and be willing to accept the negative repercussions of what may happen as well. So essentially, the golf product is a scorecard that highs a golfer's score so that they don't look at their scorecard as they play, so that they can focus on one shot at a time. So just promoting like an out of sight, out of mind experience on the golf course. So the way that relates to stock market trading is you can't look at your gains, you can't look at your losses. You just got to look at the fundamentals of your strategy and stick to the strategy and know when you get to the end of your round or you get to the end of retirement or whatever your goal may be, that you're going to be on the winner side in the top 1% of where you want to be.
Yeah, that's awesome. I'm sold. I'll buy it.
Yeah, man. So keep an eye on that. We're looking to partner up with some golf influencers and things like that. And then once we do the physical product, we also want to come out with an app-based version too.
Yeah, sky's the limit with that. That sounds like a great idea. So as far as the what is it? The coaching brand 369 Financial, right?
Yep.
What are some of the strategies that you teach as far as personal finance getting started out? Like, for example, how much would you recommend somebody diversify in their 20s versus when they're in their 50s?
So we're going to talk about diversification and choosing investments. If you Google how many stocks do you need to be diversified, you're going to get a lot of different answers. So one of the main problems that people have when they start out is what investments do I choose? Do I choose mutual funds? Do I choose exchange traded funds? Do I choose stocks? And they found through research, mathematically, you only need about 30 to 60 stocks to be fully diversified. And if you invest in an exchange traded fund called the S&P 500, you're invested in essentially 500 companies. So you're following the index, whereas from a mathematical standpoint, you only need 30 to 60 stocks. So if you're starting with exchange traded funds, which are easier to understand, you're actually going down a road of where you're actually over diversifying your portfolio, which Warren Buffett has said in that video that I'm going to share with you, that he thinks over diversification is a terrible mistake if you're looking to bring that intensity to your investing game. So if it comes to diversifying in your young 20s, obviously you want to start out small. I mean, maybe 1 to 5 stocks, depending on how much money you're playing with. I mean, if you got $1,000, that's what, $200 for 5 stocks each. Or you can just go all in on one stock with $1,000. Because I mean, if you lose $1,000, it's not going to kill you in your 20s. So I mean, it just depends on where you're at. What are you trying to accomplish? Looking yourself in the mirror and like, hey, how hard do I want to press? How fast do I want to drive this car? And am I able to stomach the losses when I hit a bump in the road?
Yeah, for sure. It seems like, especially at a young age, just as long as you're in the market and you have somewhat of a reliable portfolio, like
you got to be in the
large cap.
game. You just gotta be in the game in some sort of way. There's no cookie cutter way to invest money. A lot of these companies do have cookie cutter ways to invest money, and these companies are worth millions, if not billions of dollars. But when it comes down to it, we're all different. Like your goals to invest and my goals to invest are probably maybe similar, but similar can still be vastly different from each other.
Mm-hmm. Yeah. And as far as the actual, amount of money you put into the market versus how much you're saving, how much so say you have a certain amount of income, how much of that should go into your investment accounts? And then how much of that should you save, or how much should you keep in a checking account? How do you go about spending that money?
Step one is you got to make sure you're saving money. Yeah. So step one is focus on how much you're saving. Because if you have a high savings rate, let's just say you make, keep numbers simple. Let's just say you make 50 grand a year. You save 20 grand of that a year. That's 40% of your money. If you save 40% of 50 grand a year, in 5 years, you'd have $100,000 saved, assuming a 0% interest rate. Now, if you start adding some compounding interest onto that and you make 7-8%, your money's going to double every 10 years or 7 years, whatever. I think rule 72. I always get it mixed up. It's just hard to remember everything nowadays with the amount of information we consume. Like the rule of 72 is like, if you make 7.2% every 10 years, your money doubles. I believe that's the right way. So essentially you got to focus on saving first, because if you're not saving and you're just investing to make money and something happens in your life, which it always seems it comes in threes. When it rains, it pours.
Mm-hmm.
Then you need money, and then you don't have enough money saved up. You're going to do one of two things. You're going to end up buying high and selling low on your investments to pay off when you get a nail in your tire, or your engine blows up in your car, or you end up in the hospital with hospital bills, or something happens. Or you're going to bust out that credit card, throw money on a credit card, which the average interest rate on credit cards is at least 17 or 18%, which is greater than Bernie Madoff even made his clients, and he was a scam artist. So you start incorporating these bad habits because you're trying to speed up the process in order to take shortcuts. But there are no shortcuts when it comes to being successful. You got to do the hard work in order to get where you want to be. So if you focus on your savings, that's going to propel you to build your ultimate wealth. And I mean, you can look at any of the billionaires in the world. For the amount of wealth that they have, the life that they live is pretty fucking simple. Like Warren Buffett drives like a Cadillac, which for his net worth is like me driving a Nissan Stanza. If you even know if anyone knows what that is. So I mean, what Bezos was driving a Civic for a long time. He may even still drive a Civic. Steve Jobs drove at least a Civic or at least a Honda. So I mean, you got to live a simple life to keep your savings rate high so that you can have more money to invest. and allow it to compound over time. The more money that you invest, the more money you will make, because you can't rely on making 100% returns every 3 to 6 months on a short squeeze play like we're experiencing with Robinhood, or what is it, 300%, 400%, something ridiculous.
Something like that. Yeah. So how much cash should you have on hand to be able to make a play like GameStop or AMC?
I mean, what a financial planner will tell you is you want to have 3 to 6 months of your income in a rainy day fund. So if you make 50 grand a year, half of that would be 25 grand. So you want 3 to 6 months of your income. So it depends on your risk tolerance as well. So I mean, if you make call it 100 grand a year, you probably want $25,000 to $50,000 saved up. If you make 50 grand a year, you'd want like 10 to 20,000 saved up. Just because, let's just say you hate your job and you want to quit, you also have to allow yourself some time to find a new job. Just because with the amount of options that we have for positions, people are getting bored, people are job hopping, and it's important to have that cash on hand. Plus, when you have opportunities and you have a lot of cash on hand, it allows you to capitalize on those opportunities as well. So cash is king. You can't just look at it as like, oh, my cash is on the sidelines, not making any return. As long as you have a solid investment strategy, you know you're going to put that money to work at some point in time, but you just got to find the right opportunity, which sometimes takes 6-12 months, maybe even longer. But if you don't have that cash, you can't buy the things that you want to buy.
Yeah, I think that's really important, because you're not losing money if it's on hand for a specific reason, whether that's so you don't have to go into credit card debt, or that you can't jump on opportunities when you need to. Kind of touching on this GameStop situation, who do you think's at fault here? Is it the big hedge funds, or is it the Reddit warriors?
I don't think anyone's at fault. I just believe this is a situation that most people don't understand. And when we don't understand something, as children, we typically get upset. It's kind of like when you don't understand when you're hungry, when you're a kid, and you just start to cry. And when these situations happen, when you're a new investor and you felt that you should have been making a huge return on a situation, and then the company just freezes your account and you're not allowed to do it, you look at it as a loss. And so you don't know how to react to that loss because you don't understand what's happening. But short squeezes have happened a lot. And a lot of people have made a lot of money on short plays, as we've seen in the Big Short, shorting the mortgage-backed securities, how he was able to make over 100% return in a year when the market had its worst return since the Great Depression of the 1920s. So, because you gotta think about it like this. So, does it suck when the hedge funds did what they did, and the little Reddit warriors are kind of like, oh, like big business is holding us back? Yeah, that does suck. But at the same time, Robinhood allowed this to happen, because how does Robinhood make money? They sell your data to these hedge funds, so the hedge funds know which companies to short.
Yeah.
So the hedge fund's in this position because GameStop is selling them the information. The investors are in the situation because Robinhood's free. It has confetti and fireworks, and it's fun, and it's easy, and they allowed you to come on their platform, and they'll give you a free stock, and it's free. It sounds too good to be true, which it is. Then the hedge funds' pants are below their ankles because the Reddit warriors came together and pulled enough money to artificially inflate GameStop up in value, which there was no fundamental reason it should go up. But the hedge fund has enough money in the bank where they're like, we need to cover our losses, so we're going to hop on that train too. So that actually caused the stock to go up higher because the hedge fund's putting money in after all the Reddit, so that's causing it to go up. The hedge funds close out their position to mitigate their losses, and then it causes lots of fluctuations with the stock price once the hedge fund is done with their business, and basically just pushing the red button. It's kind of like gambling casino. Like the casino has an unlimited amount of money. You have a finite amount of money. There's only so much money you can make based on how much you're saving in your bank account. I mean, that's what it comes down to. It takes money to make money.
Yeah. So, I mean, a lot of people are accusing the big hedge funds of market manipulation, and especially because of this concept of short selling, kind of like what they did to GameStop. Can you kind of walk through that and explain how that works, and is that market manipulation?
Yeah, that's a slippery slope. And I mean, is it market manipulation? Kinda, but you got to put yourself in the hedge fund shoes.
Yeah.
So it's like, all right, I short a company. My short's not working. How do I get out of this trade? Do I just accept my losses and I just exit the position and I lick my wounds and I just say, all right, screw it? Or if you think like smart money, you're like, well, I'm playing the short position. Let me also play the long position so that I'm playing both sides of the equation. I'm playing the downside and the upside. And if I get the upside to go up enough in value, I'll be able to wipe out my losses on the short, get out of the trade, and mitigate the losses. Which, for all investors, that should be the game: is mitigate your losses and increase your winning percentage. So, I mean, for example, let's just say you do options trading.
Mm-hmm.
If you buy a put option, you are betting that companies that go down, depending on the length of the contract.
Yeah.
You can also buy the same stock and think it's going to go up in value over time as well. So you're limiting your upside gain, but you're also limiting your downside losses. So that's what the hedge funds were doing. Now, they just have enough money where they manipulate the stock price to go absurd. But at the same time, you could also look at that the Reddit warriors were also doing a form of market manipulation because they came together like, oh, let's just put all of our money in. So, I mean, they're doing the same thing. It's just one is big business and one is like the common folks. And like everyone loves an underdog story. So basically, is anyone at fault? I mean, I think Robinhood's at fault because they're the platform.
Yeah. Well,
and they're the one who is selling the data. But I mean, this is just how investing goes, man. It's a zero-sum game. It's not like Little League Baseball where everyone goes home and the game's tied. There's always a winner and a loser.
Yeah. It does seem though like because these big hedge funds, they've been doing this, that's the name of the game, like you were saying, in 2008 when, the betting against the housing market and all that kind of thing. And then they just get bailed out. But when it's the little guy that gets the win, all of a sudden it's like, the CEO of the NASDAQ's coming on TV and saying that there needs more regulation now, like the complete opposite of what you would think for the CEO of the NASDAQ to be saying. But and then even what happened with Robinhood and a few other platforms where they were restricting trading, is that like, that's never happened before, right? Where they basically make it you can't buy.
I mean, if the stock market, there are certain rules that if the stock market goes down a certain percentage in the day, they'll shut down the markets.
Really?
So they've put these rules in not just for traders, but for the full market. I mean, I don't know exactly what it is. I think if the market goes down like 10% in a day, they'll shut it down.
Oh, wow.
To keep too much funny business from happening. Because I mean, why do we protect the big companies and not the little people? Well, it's because the little people are invested with the big companies.
Yeah.
So when you think about it like that, it's like, who do people bank with? They bank with all these large firms. So if the large firm goes down and they go bankrupt, then the money that you have in your bank account is then worthless. But at the same time, you're like, man, why do always the big companies get the most dollars? So it's kind of like a catch-22. But at the same time, the way around that is to stop supporting big businesses and start supporting more small businesses that would force the money to have to flow to other places as well.
Yeah.
But at the same time, I get it. Like, people are pissed. They have every right to be. I've just always been taught that if I can't argue both the positive and the negative of a situation, I'm not allowed to have an opinion on it.
Yeah.
So I always do the best I can to put myself in both shoes.
That's a really important perspective, because no one acknowledges the other side of that, of how much we rely on these big hedge funds and how deeply rooted they are in a lot of the finance that, we're involved with. And, if they were to go under and just completely be bankrupt, yeah, sure, like, good, we stuck it to the guy, but now, like, everyone's retirement account is screwed, or whatever the result of that is. Maybe for the few people that turned into millionaires off of GameStop aren't worried about it, but yeah, that's a perspective that not a lot of people acknowledge. So I'm
Yeah, I
glad.
mean, think about where you bank. Think about who's your cell phone provider. Like, what would happen if like Xfinity went bankrupt?
Yeah, yeah, that's pretty funny. So with the 2008 market crash and all of that with the subprime mortgages, Michael Burry was the guy that was, kind of found that and bet against it and made all that money. Did you know that he was one of the first guys to post in that Wall Street Bets group, and he put 50 grand on GameStop like a year ago or something like that?
No,
The
I
same
didn't
guy,
hear
yeah.
that.
Yeah, I mean, I read it somewhere. It might not be true, but I'm pretty sure that he put 50 grand in. There was all these articles, right? People were writing about it saying he was an idiot. And then he pointed out that the big hedge funds, I think it was like Melvin Capital was one of the big ones, that they were shorting GameStop. And then he put that in the Reddit group, and then everybody jumped on and made the price go up. And then, the big hedge funds were worried because they would have to buy back at a higher price. I think that's, kind of the biggest concern on their end was having to buy back those stocks at a higher price because it didn't go down. But yeah, I mean, that's some crazy analytics that guy must be going through to see all these the biggest moves in the market twice.
Yeah, I mean, that's crazy. I mean, someone like that who has clout, I mean, they could just tweet, as we see with the Elon Musk, he'll just say Dogecoin and it'll go up. Uh, uh, I mean, is that not market manipulation, or is that just people saying like, I believe on Elon Musk, I believe in Warren Buffett, I want to buy what they're buying? I don't think there's anything wrong with that. It's just when it's a free market and all you need to do is have a cell phone and a provider and have access to your bank account to put money in. I mean, it's very simple to, you know, hop on these trades and get this information in real time. Like, think about it. Like, back in the 20s, in order to know what the big people are buying, you'd have to wait till it came out in a newspaper, or you'd have to call a broker and have the broker place the trade for you. So the amount of speed that you're able to place trades, and you're getting information directly from like Warren Buffett or an Elon Musk or Michael, what's his last name?
Burry, yeah.
Burry. And so it's basically like, oh, like you can basically go on any website, you can see what the insiders are buying and just follow the money.
Mm-hmm. Yeah, it's definitely a new age of investing. And even now it seems like there's going to be a new type of investor where it's just reading Reddit groups and seeing what the next wave might be, and going all in and jumping ship at the right time. I don't know if that's the most effective for longevity, but certainly
Yeah,
interesting.
I won't be doing that. A friend of mine told me like, hey, you should hop on Reddit. It's an online community, and I attempted to give some advice, but I just found on Reddit like you could be given the right answer, but if people don't like your answer, they just they flip out on you because it's the internet. Like,
Yeah.
I mean, you could give them like, if I go on there and say, hey, buy this, like you're gonna get a lot of haters out there. Um, so this is just something people will look back on 5-10 years from now and be like, oh, that was crazy, and then it always fizzles out. I mean, that's what always happens
Mm-hmm.
with these sort of things.
Yeah. Um, how much should someone be investing if they have debt?
Depends on the interest rate of your debt. I
Mm-hmm.
was working with a young lady that's a vet, and she has student loans that have a 7 or 8% interest rate. So, being that we're in a very low interest rate environment, we got to look at refinancing her student loans to something lower. So let's just say we can get her down to a 3% rate. You have to look at what's called an arbitrage opportunity. Are you familiar with arbitrage?
I'm not.
So basically, like, let's just say you're borrowing money at 3%, and you can buy a stock that pays a 5% dividend. You're basically borrowing money at 3% to make a free 5%. So you pocket the 2% on borrowed money.
Yeah.
So when it comes to debt, you got to look at what rates are you paying on that debt, and how much can you make if you put your money elsewhere. So you want to be putting your money into things that are going to make you the most amount of return.
Right.
At the same time, you got to pay off your high credit cards, because that's 14, 20, 25%. And it's unlikely that you're going to make 25% on average each year over year in the stock market. I don't even think Warren Buffett's done that well.
Mm-hmm.
So that puts things into perspective a little bit. So essentially the answer is, if you're in high credit card debt, you got to get that refinanced, moved over, paid off as soon as possible. If you focus more on good debt, which would be like a mortgage, I mean, mortgage rates are below 3% nowadays. Then you can also put your money into things that bear more return, which would be like the stock market, perhaps cryptocurrency. Who knows?
Mm-hmm.
I mean, that's the way I look at things, and that's what I always teach people that come to me. As well as you got to think about, can you handle the debt?
Right.
Can you handle seeing that on your? Can you handle being $100,000 in student loan debt? Or do you need to, for your peace of mind, so you can sleep better at night? Do you get that paid off as soon as possible? And that's not something that you or me can answer for someone that's takes a little bit of soul searching.
Yeah, 100%. And I think it's important to have nuance to your finance. And, I think if you're saying all the time, always, this is how it works, it's never going to be the right way. And especially with a topic like debt. I know a lot of people are, Dave Ramsey kind of preaches the whole no debt. And it almost seems like that's just like a safe bet for people to just not mess it up, because, if you get into debt and, you think of debt and like a credit card debt, and that's, usually not good. But whereas if you can use your debt, or, even investment, like with student loan debt, I'm guilty of that. I got a lot of student loans, but it's like the return on investment.
I just paid it off this last year.
Hey, congrats, man. Yeah, that's one of my biggest goals, is to get that down within the next, I got a cut on my lip, it's bleeding. Is to get that down to 0 in 10 years. That's my goal. And it's, I'm up there, but I'm a pilot. So that kind of comes with a lot of student loans if you don't have the means up front. But I think it's worth it. That's what I want to do.
I mean, rather than focusing on the negative, which is the student loan, and like, oh, I'm in so much debt, I feel like a lot of people look at the positive. It's like, all right, if you didn't take on the student loan debt, what's the chances of you becoming a pilot?
0. Yeah.
Basically 0. So, I mean, you're basically, if you think about it as a poor mindset, and I would say poor, like, not wealthy, not like poor, like negative. If you have a poor mindset and you're like, I don't want to accumulate debt because debt is bad, you're limiting your potential, because what do all the big companies do? They borrow money to grow. And the only way to grow is to have more money. And if you don't have a certain amount of money, the only way to get more of it is to borrow it, so that you can obtain something that you couldn't obtain on your own. So, I mean, I'm with you 100%. As far as Dave Ramsey, I think Dave Ramsey's great if you want to live a average upper middle class life. That's what he's geared towards. No debt, invest in mutual funds, buy term insurance. He also uses the church for a platform as well. But if you're looking to do something greater than that, then I feel like Dave Ramsey isn't the proper person that I would suggest someone to listen to if you're looking to be in that top 1%.
Yeah, I agree. And even going back to the student loan thing, I think it can be more of a negative if you go into it not knowing exactly what you want to do, because then, you can kind of just spend a lot of money to figure out what you don't like. And then you'd probably be better off just, trying things without the debt. But for,
like, don't go to school and get 50 grand in student loan debt and like become a teacher where like you're not going to make any money as a teacher. Like, people know like what your income's going to be. Like, obviously, if you love teaching, like maybe you should go to a different school and not like accumulate a bunch of debt just to become a elementary or middle school teacher. Nothing against teachers. It's just like, these are the things that we're not taught. And if people don't tell us, and the school is willing to give us this money, I mean, I don't know about you. I saw people taking out student loans and just like going to buy the new MacBook Pro, going on spring breaks, taking some of that student loan money, putting in the stock market. Like, things that college kids do with the student loan money is crazy.
Yeah, I agree. As far as as far as some of that good debt you can have, how would you say someone should start to invest in real estate, or is that something that everyone should consider?
Well, real estate's great because it's a form of you borrowing money that you don't have to obtain an asset that you currently can't afford. And then a bank gives you money so that you can pay that asset over 15 years, 30 years. You want to grab a napkin for your lip, bro? And I'll
Yeah.
just keep talking.
Yeah, sure. I'll be right back. Sorry.
So I'll freestyle a little bit while Brennan gets a napkin, his lips bleeding. So basically, when you get a mortgage for your house, you're borrowing money from a bank to obtain an asset that you currently can't afford. So let's just say you're buying a $250,000 house and you're going to then get debt to obtain that house, call it at 3% interest rate. Or perhaps you want to buy a rental property. So a rental property essentially allows you to get other people to pay off your debt for you, while also the investment, which is real estate, also appreciates in value over time. So one of the main reasons that real estate goes up in value and it's created the most millionaires in America is because due to this leveraging, which we're taught that mortgages are good, like mortgages is a good debt. But when it comes to borrowing money to invest into the stock market, we're taught that that's bad. However, when it comes down to it, you got to borrow money in order to make money. You got to save money. You got to make sure that you leverage yourself in order to get you where you want to be. And when it comes down to investing in a primary residence, I mean, real estate only really goes up about 3 to 5% on average each year, which isn't very high. But if you have a $250,000 loan, you only put $5,000 down on that house. You're then leveraging your money at a huge rate. So that 3%, even though it's small, it allows you to compound over time because you put so little money down. But on the flip side, you also got to look at it as how much interest you're paying for that loan over time as well. So if you're paying a 3% interest rate and real estate only goes up 3%, that's a very small arbitrage opportunity. If you listen to someone like Grant Cardone, I don't know if he actually is a billionaire. I've heard some sketchy things about Grant Cardone recently in the news. Obviously, he claims to be a billionaire and invest in real estate. He does preach that buying a primary residence isn't a solid investment strategy. It's a solid investment strategy if you own a bank, because basically they borrow money, you pay the bank, and they make interest off you having the right to own a house. But he really believes in owning. If you want to own real estate, you got to have rental properties because you get the income, and you can basically take someone else's money to pay off your debt. Which, I mean, isn't that great? You just get other people to pay off your debts for you. You just let them live in the house that you own. But when it comes to owning a primary house, you really, I mean, it's not paying you. And basically, if you've ever heard a book, have you ever heard of the book The Intelligent Investor by Benjamin Graham?
I have. That's on my list of books to read this year.
Yeah. So I believe it's in that book. It says an investment is only worth as much as it pays you. So if you live in a primary house, how much does it pay you? Zero. How much does a rental property pay you? It pays you the rent that you're charging your tenants. If you own a piece of gold, it doesn't pay you any dividends. Cryptocurrency pays you no dividends. A blue chip stock is going to pay you dividends, and that's how much an investment is worth. Is how much is it paying you? So that's my 2 cents on real estate. I think if you're great at fixing things and you don't have to hire help, then real estate can be extremely profitable. If you're bad at fixing things, you're going to have to hire contractors and plumbers and people to come fix things, then probably real estate's not the way to go unless you have deep pockets and depending on what kind of real estate you're purchasing.
Yeah, one thing I really like about real estate is that, the ability to scale it. I think that there's a lot of room to do that, but also it's something that kind of everyone at some point is going to be invested in. Everyone's eventually going to buy a home. Maybe not everybody, but a lot of people buy a home. And so if you can use that as a way to kind of get into it as an investment, like even with something like house hacking, where you're going to buy a home anyways, you are saved enough, you've put a down payment, or even using an investor and someone else's money, And then even just like renting out the other rooms. And then you can use that money to just pay off the mortgage or, pay off your other debt, whatever it is. So I think that's a good way to at least get some skin in the game with real estate, is even just with the first home you buy. So that's
Yeah.
something I really want to do. Um, I'm still.
Yeah, I mean, I bought my first house at 25. It was 5 blocks from the beach. It was in a area that people used to call the Hill. They called it the Hill because a lot of drug addicts lived there. But I saw an opportunity. I'm like, I'm 5 blocks from the beach. It's a brand new construction. I'm 25. I don't have a wife. I don't have kids. I don't have a girlfriend. Um, so basically, I bought the house. I wanted a 4-bedroom because I wanted to be able to rent out as many rooms as possible. The more rooms you have in your house, the more people you can put in there, and the more you can spread out your risk. Because if you have a 1-bedroom house and you're reliant on one person's income, and COVID-19 happens, that person gets out of a job, your entire income is screwed.
Mm-hmm.
Whereas if you have a 3, 4, 5-bedroom house, you're spreading out your risk over 4 or 5 different tenants. In addition to that, I was living in the house, renting out the 3 rooms, and at the same time, people were paying me rent, and I was using that rent to pay off my mortgage. I just had to share my space with other people, which can be challenging at times. But you also got to think on how much, not the dishes people are leaving in the sink and the mess that they make. You got to think about how much money is this person helping you save, or how much they're helping you accumulate in order to make your dreams and aspirations come true. So that was the recipe that I did. And then the market's gone up a lot. I decided to sell my piece of real estate. I live in an apartment now, so I don't have to fix anything, which is great. Don't have to mow the lawn. Don't have to call a plumber. If I put a hole in the wall, like, it doesn't even matter. So it just allows me to save so much more time, not having to worry about as many responsibilities, because my bulk of my investments are in my businesses, not in real estate. But I know that for most people, real estate can be a very lucrative way to make money.
How did you go about finding tenants to live there? Were they people you directly knew that you got to live there?
Yeah, they were friends of mine.
Yeah, it seems like
Everyone wants to live at the beach. Everyone wants to live in the happening places, and you had a brand new house, and I had people reaching out to me to live there. Because when you're in your mid-20s, you still have friends that are renting together. I mean, once you start getting your 30s, I mean, everyone's pregnant, married, engaged. So your pool of friends starts to dwindle. So as you get older, you start having to rent with like people that are younger than you, which can be a good thing or a bad thing, depending on the quality of your roommates.
Yeah. Yeah, or there's something like a duplex where you could just have that completely separate. But overall, I think some sort of real estate investment, as long as it's making you money, can be very advantageous to building wealth. Well, cool. I don't want to take too much of your time. I do have a couple questions I like to ask all the guests because it's the Get Wealth podcast. So first off, what's a book you recommend? And then what is your definition of wealth?
Book I would definitely implore everyone to read is The Investment Strategy that we used at 369 Financial. It was written by 2 Yale professors. Their names are Barry Nailbuff and Ian Ayres. And the name of the book is called Life Cycle Investing. And life cycle investing allows you to increase your nest egg by 50% without increasing your savings by 50%. And it's a way to decrease the amount of risk that you take by focusing rather than on asset diversification. They actually found through their research it's more important to focus on time diversification. So that's definitely a hidden gem. Not a lot of people know about life cycle investing. And the reason behind that is when you're a Yale professor, you write your book, you win a bunch of awards for your research, and then you move on to the next project. So they spent pretty much no time marketing this book. And it's definitely, in my opinion, probably one of the top books on investing out there. It'll really change your perspective on how to invest money. As far as getting wealth, and my definition of wealth is essentially being able to do whatever I want to do when I want to do it. And wealth gives you that freedom. if you want to take a break from work one day just because you're not feeling it, you need a mental health day, you want to go hang out with your friends at the beach or go for a hike or hit the golf course or just lay in bed with a good book and drink a tea or a coffee. Wealth gives you the ability to sit on your butt if you need to, and take those days off, rather than if you become a cog in the system and you're always having to go somewhere or rely on other people for money. Then they're basically rowing the boat where they want to go. Rowing the boat where they want to go, rather than you got to row your boat where you want to go. And that's what wealth allows you to do.
Yeah, well said. Well, listen, Josh, I really appreciate your time today and sharing your knowledge with the Get Wealth podcast.
Thank you.
Yeah. How can people find you as far as Instagram, your products, your business? Where can
Just Google search Josh Krafchick. People tell me I need to do like call to actions, like subscribe, like, comment. I'm just like, if someone really wants to find you nowadays, like, it's super easy. So I mean, you can find me on Instagram. Just search my name, LinkedIn, Google Josh Krafchick. So Josh Krafchick, Kraf as in Foxtrot, Chick, Chick. It's just not my style to like beg people to like my stuff. I just figured if I put quality things out there, eventually people will like and comment and share it. So
yeah, and you're on Clubhouse now, literally right now.
Yeah, Clubhouse. We are. I know Harrison's in there.
Yeah, what's up, Harrison?
I don't know if he has any questions or anything like that, but we can hop on Clubhouse and talk to him for a bit.
Oh yeah, I get some feedback from my phone's too close. But Harrison, are you listening right now? He's probably just got it in his car. I don't think he can. He's paying attention right now. Hello, Harrison, you there?
I can invite him to speak.
Oh yeah, can you do that?
Send him an invite. Yeah, Harrison should be able to talk now.
Oh, there he is. Hello, Harrison. I think I can get you on the speaker.
Hey, can y'all hear me?
Yeah, I got you. Any questions, man?
Joshua, Brennan, how's it going?
Going good?
Good.
Hope there's not a lot of background noise. Got my tires slapping the road right now.
Where are you at right now?
I'm about 10 minutes out of Sedona. So.
Oh, nice.
Yeah, man. Dude, I don't have any specific questions. My only question was gonna be like books, recommended books. But dude, awesome podcast. I don't know if you guys noticed, I dropped out for a little bit. I lost service. So sorry about that, but I got a good chunk of that. So.
Well, cool, man.
Thanks for keeping me in the lobby, letting me listen.
Yeah, for sure, man.
Well, cool. All right, man. I'll let you get to it. You can sit and listen. We're wrapping things up here, so appreciate you tuning in. Go.
Cool. Well, thanks, Brian. It was fun, man. We can do it whenever you want. You need any investment advice, hit me up anytime. I'm an open book, and look forward to seeing where we can go with the Get Wealth podcast. I'm excited to see where this goes.
Yeah, me too, man. Thanks again. All right, everybody. Get wealthy.